Welcome to The Explainer. Today, we are breaking down an absolutely massive story in the global commodities market. We're looking at the mining giant Glencore and their incredibly strong first half 2026 results. Just to give you a sense of the sheer scale we're dealing with here, their revenue climbed nearly 50%, hitting a staggering $174.43 billion. So today, we're going to follow the money. We'll figure out exactly where it came from, where they're putting it, and why this matters so much to the broader global economy.
Okay, let's dive into this follow the money framework. We've got 5 key areas to cover. First, we'll look at the billion-dollar turnaround itself. Then, we'll see how they're rewarding shareholders and their big ASX move. Third, we'll jump into the global copper scramble before looking at what Wall Street is saying. And finally, we'll wrap up with the very real risks and roadblocks ahead.
All right, part 1. Let's talk about the sheer scale of this financial swing.
Just look at this stark contrast from their August 5th half-year report. In the first half of 2025, Glencore posted a net loss of $655 million. Now fast forward exactly 1 year, and they are posting a $4.4 billion net profit. That is a $5 billion swing in just a 12-month period. This dramatic shift is really the core mystery we're unpacking today. How exactly does a commodities giant flip the script quite so dramatically in just 1 year?
Well, a big part of the answer lies right here, 86%. That represents the year-over-year surge in Glencore's adjusted EBITDA, hitting $10.1 billion for the first half of 2026. They comfortably blew past the analysts' forecasts, which were sitting around $9.5 billion. And because they've got this incredible momentum going, management actually went ahead and raised their full-year guidance to $19.7 billion.
So what were the twin engines actually powering this massive profit? Well, it essentially boils down to 2 segments, industrial and marketing. On the industrial side, so their physical mines and production assets, earnings jumped 72% to generate $6.5 billion. That was largely driven by surging prices across the board. We're talking copper up 39%, zinc up 22%, and thermal coal up 24%. But then take a look at their marketing and trading business. That segment delivered $3.3 billion, which is an absolutely wild 142% increase. That near-record performance was directly driven by extreme volatility in energy and freight markets, largely following the escalation of conflicts in the Middle East.
Glencore's CEO, Glenn.L, really hit the nail on the head summarizing this, saying, "Our assets performed in line with market guidance, which, alongside substantially higher period-over-period average prices for our core commodities and a favorable marketing backdrop, underpinned a material increase in earnings." So basically, high commodity prices and extreme market volatility came together in a perfect storm for them.
Moving on to part 2, let's look at what Glencore is actually doing with this windfall.
With billions of dollars suddenly flowing into the coffers, they are returning a good chunk of it straight to investors. They just announced a $1.5 billion top-up return. This is made up of a special cash distribution of 8.5 cents per share, so roughly $1 billion, alongside a brand new $500 million share buyback program that'll run through February 2027. If you add that up with their previously announced distributions, Glencore's total shareholder returns for 2026 sit at a very healthy $3.5 billion.
Now, what's really interesting about this strategy is this number right here, 12.4 trillion Australian dollars. Glencore is targeting a secondary listing on the Australian Securities Exchange, or ASX, by October 2026. And you might be wondering, why Australia? Because they hold one of the world's largest and fastest-growing pools of long-term investment capital through their pension assets, which are projected to hit a whopping $12.4 trillion by 2045. Glencore wants a direct pipeline to that immense wealth.
And analysts are seeing the vision here. Glenn Lockhawk over at Barrenjoey pointed out, once it gets here, if it can get the liquidity and the market cap size that it needs, it could be in the ASX 100 by as early as March-April next year. This is a highly aggressive strategy, giving Glencore access to deep pools of long-term capital. And they need that capital to fund their massive copper growth, and frankly, to potentially revive some transformational M&A ambitions, especially after those talks with Rio Tinto fell through earlier in the year.
And that brings us perfectly to part 3, the global copper scramble.
Let's move to and see how this builds out, because copper is the ultimate centerpiece of Glencore's growth strategy right now. It's the primary target for all that newly acquired capital. For 2026, they're holding steady at a guidance of 810,000 to 870,000 tons. But watch this ramp up. By 2028, they aim to hit 1 million tons annually. And by 2035, 1.6 million tons. This massive acceleration is entirely fueled by surging global demand.
The world desperately needs copper to build out power grids, electric vehicles, and increasingly, AI data centers.
And a huge chunk of this production growth is coming straight out of Africa. In the first half of 2026, their African operations were the absolute standout performer, with copper production jumping an incredible 66% to 138,400 tons. This jump was thanks directly to improved mining rates and finding higher ore grades out of the Democratic Republic of Congo.
Of course, the world is practically lining up to buy what Glencore is mining. Take this major deal from August 17th. The Export-Import Bank of Korea provided a $1 billion loan to Glencore. The catch? In exchange, Glencore committed to supplying a stable stream of copper to South Korean companies for the entire duration of the financing. This is the macro narrative perfectly encapsulated. Major industrial economies like South Korea are urgently scrambling to lock down raw materials for their advanced industries.
So, with all this going on, let's look at part 4. How is the market actually reacting?
To put it simply, they're loving it. Glencore has been a massive standout on the FTSE 100 lately. Shares have risen roughly 95% over the past year. Recently, the stock actually crossed its 200-day moving average, hitting 580.10 pence in some incredibly heavy trading.
When you look across the board at analyst sentiment, it's overwhelmingly bullish. S&P Global polled 20 analysts, and the consensus rating is a solid buy, with an average price target of 623 pence. You've got major players like Citigroup and Goldman Sachs throwing out high price targets of 780 and 680 pence, respectively. Now, just to be completely comprehensive here, we should point out that JP Morgan holds a neutral stance with a 510 pence target. They've cited some valuation concerns, but overall, the street is heavily buying into this turnaround story.
But we do need to be realistic here. Let's shift to part 5 and look at the risks and roadblocks.
Every massive corporate turnaround carries inherent market and operational risks, for sure. Right now, there are 4 primary headwinds facing Glencore. First up is valuation. The stock trades at a staggering price-to-earnings ratio of 193.37, alongside a very high debt-to-equity ratio of 108.47. That's expensive, and it leaves very little margin for error. Second is cyclicality. Commodities are notoriously boom or bust, making them vulnerable to downturns. Third, rising input costs. Glencore actually saw a $1.1 billion increase in cost for essentials like diesel and sulfuric acid, which was worsened by supply chain disruptions. And fourth, you have political and regulatory risks, primarily because their copper growth is so heavily concentrated in regions like the DRC and South America.
And then there's a very specific, looming financial unknown, the Radiant World provision. Glencore is currently facing scrutiny over the validity of invoices related to an iron ore trader called Radiant World. Now, CEO Gary Nagel insists this exposure is not material, and he's actually declined to quantify it publicly. However, sources are suggesting a provision of anywhere between $500 million and $800 million might be hanging over the company.
Finally, we can't talk about Glencore without mentioning their legacy energy business. They remain the world's largest thermal coal exporter. In fact, coal exposure represents about 15% of their underlying industrial earnings. Regardless of where you might stand on global energy policy, from a purely financial perspective, this 15% chunk presents ongoing environmental, social, and governance, or ESG, risks. That alone may objectively deter certain large institutional investors from wanting to hold the stock.
So, we end up with this profound tension at the heart of the company. On one hand, you've got this incredible energy transition pipeline centered around copper, record cash flows, and a brilliant strategic pivot to tap into Australian capital markets. But on the other hand, you're looking at steep valuations, unpredictable geopolitical risks, and that heavy legacy coal exposure. So, the question we have to leave you with today is this: will Glencore's forward-looking copper boom ultimately outweigh its legacy market risks? It is absolutely a fascinating space to watch. If you found this explainer valuable and you want to keep following the money with us, make sure to subscribe for more deep dives. We'll see you next time.